Welcome to FX Options University, recorded live at the International Securities Exchange, the world's largest equity options exchange. Join the industry's top trading professionals as they provide insight and strategies for trading in the currency markets using FX options. FX options are a low-risk alternative to hedging currency moves in any market condition.
So what's China doing with some of this? Well, they're turning around and they're buying European bonds. And when they buy European bonds, what does it do? It pushes up the value of the euro versus the Chinese currency. So Germany is less competitive against China in that situation. So they get the, in one sense, they get the PR impact of coming in helping to save Europe by buying the bonds, but in another sense, by pushing up the euro, they get a competitive advantage. The Japanese have been screaming about this for months and months, going in and buying it with these massive amount of reserves that they can just, they're just running around the world like the 800-pound gorilla with these reserves. Buying yen bonds is doing the same thing, pushing up the value of the yen relative to the Chinese currency, and of course pushing up the value of these currencies obviously against the U.S. dollar. So, and obviously, as we just talked about, it's inflicting a lot of pain and pressure on the emerging markets because of all this money flowing in. These guys have to take it on the FX side, FX increase, where China doesn't. So you have really a major dislocation because of the fact that China keeps its currency suppressed. It creates this massive amount of FX reserves. And the Fed's implicit policy of weakening the dollar is adding to this problem in a very, very big way. So it's kind of a catch-22 for the Fed. They have to weaken the dollar in order to try and create liquidity out there to keep demand alive. But yet the more they weaken the dollar, the more they exacerbate this situation. And one could say, well, maybe the Fed's a lot smarter than they look, and this is a giant Machiavellian game, and they're ticking off everybody around the world against China and just, making it appear that China's the bad dog here, which they are to a large degree, obviously, not all of it. But so from a Machiavellian standpoint, this implicit weak dollar policy is pressuring China in a very, very big way because we're finally seeing we refer to as collective criticism from every corner of the globe against the current policy of China maintaining its currency where it is suppressed. So where do we go from here? And we'll get to some of the currency charts. Obviously, one of the problems that we have here is this whole idea looming of the trade war. And given the fact that demand hasn't returned, given the fact that the politics is what it is, not only here and throughout Europe, the politicians trying to keep their jobs, and people's moods changing in a very, very big way, and the fact that the West really has only one way to protect themselves from China with the type of export policy they have is through tariffs. So if something doesn't change, given the mood, given the dire state of the real economy, we think tariffs are there and a very are going to come out. There's a lot of things going through Congress working through, so that's really part of the problem, the whole trade war problem that this can lead to. And China sees it, and China, understands this and understands ultimately if they get into a trade war, they will lose. It will be bad for everybody. It will be a lose-lose for all the global economy. But I say they will lose because they're still highly dependent on U.S. consumers, and also the fact that the U.S. has a domestic consumer market. The U.S. has some depth in its capital markets. So in a trade war, the U.S. Would win. That won't always be the case, obviously. And if China does develop its domestic markets, it doesn't need to hold as many U.S. bonds and things. It won't be as dependent on the West. So there are reasons why China should allow its currency to appreciate. In fact, I gave a talk in Beijing. I was invited there. I'm not quite sure why, but at this high-level FX conference, and I pointed this out. The relative benefits to China and the ability to stave off what I saw was a swing from capital to labor and real problems showing up here. But needless to say, nobody really cared or listened. But China's starting to listen now, and if they don't do something here, especially now with the collective criticism pointed their way, I think it's just a matter of time before this idea of a trade war becomes a reality if they continue to dig in their heels. If there's an implicit agreement afoot, what we would probably see, and which changes the dynamics for the dollar, and is part of the story that we're looking for, as I said, to grab on here. If there's an implicit agreement afoot, it means the U.S. pulls back on flooding the market with dollar-based credit and creates because the credit bubble problem that is creating for the emerging markets is enhancing China's credit bubble problem. So the pressure is there, too, because of this U.S. flooding the market with dollars. Last week, we saw, for the first time in a long time, Treasury Secretary Geithner come out and say the U.S. does not want a weak dollar. The U.S. cannot devalue its way to wealth in the world. It's a terrible way to go about running an economy. Whether he meant it or not, the fact that he said it publicly was very, very interesting to us, and he was absolutely right. You can't devalue your way to prosperity. And it's another thing, just as an aside, that drives us crazy. When we hear analysts and economists say, well, you have to have a weaker dollar for the U.S. economy to rebound, we keep saying, well, Germany's done pretty well with a strong currency. Australia's done pretty well with a strong currency. So this idea that you must have a weaker currency to perform is total hogwash. And in fact, a weak currency in our book hollows out your economy, because why would anybody want to put fixed plant and equipment when they know the implicit policy is to continue to weaken the local currency? In effect, it drives capital offshore, and that's no way to build wealth in your own economy. So when people say that, just look at the empirical evidence. The empirical evidence that counters it is everywhere, but yet they still continue to say it. It drives us crazy. Anyway, I was saying that Geithner came out and actually said something like that. The next day we had China surprise increase in the Chinese interest rates. Then we went into the G20. Now, most people poo-pooed the G20 and said nothing was done, but in effect, I think there was more accomplished than meets the eye. One of the things was the surprise that right away they increased voting rights for the emerging market countries and China. Again, maybe that's part of the quid pro quo here. The interest rate hike, Geithner coming out and saying that. And if it is, and now, of course, Geithner's in China now, I think, and more talks are going on, they're huddling. I think if the market starts to see some type of implicit agreement here, and I'm not talking about a one-off revaluation of the Chinese currency, but I'm talking about implicitly where China says they're going to allow their currency to continue to appreciate, in a marginal fashion, but a steady appreciation. We could see the U.S. In turn pull back on the quantitative easing too, and if those quantitative easing 2 expectations were to fall, meaning the Fed doesn't put as much money in as everybody had counted on and has bid it up and used to bid up the stock prices, we could see a big change there, and obviously a change to the dollar. It doesn't take a big movement at the margin and expectations to make a big price change in the currency market, especially when there's a one-way bet afoot, and we know that there's a massive one-way bet afoot against the U.S. dollar. We were looking at some numbers that we got from Elliott Wave, which I think came from futures, I forget what it is, futuresource.com or whatever, showing that sentiment, U.S. dollar bear sentiment is at a level where we've seen before when the dollar is turned in a decent multi-month trend change, very, very massively bearish against the dollar, and that should be no surprise to anybody listening.
Thank you for participating in this week's session. Please join us again next week. Get trading ideas, exchange rates, webinars, news, and commentary. Visit www.fxoptions.com. ISE FX options can be easily traded through all options-enabled brokerage accounts. These exchange-listed securities are cash-settled in U.S. dollars and have a European-style exercise.